All right, everyone. So thank you for having me here. This is the first time I've joined you guys on this platform. Uh, we are going to be studying three specific signs of trend exhaustion. So as we look at the different charts here today, I'm going to share with you some of the live market from today's session as well, so that you can see how these apply to our current markets. So I know a lot of you trade many different markets out there. What are some of them that you're most, I guess what are your favorite ones? What are the favorite markets that you guys trade? Let's go ahead and have you guys post that into the chat channel here. And I am going to head on over to my different charts and we'll come back to some of your responses here. A lot of Forex and futures traders. Nice. All right, you guys, don't bet the farm, right? Oil and natural gas. I'm a big oil trader too. All right, so how do we recognize trend exhaustion, everyone? There are going to be three specific things that we're going to look at in today's session, but let's start with just the basics. I don't know everyone's skill level in here. So just to start with, we are looking at a very simple trend. We've got our uptrend, which is our series of higher highs and higher lows, our downtrend with lower highs and lower lows. Now, the tricky part tends to come into play when we are looking at zones like this and recognizing, hey, how do we know that this market is going to start to turn over versus when it's going to go into a longer trading range or when it just might go into a zone of congestion where things kind of just, slow down and then they go ahead and continue. So how do we recognize the end of the trend and when we're most likely to see these longer zones of correction or even these trend reversals? So the first thing that you need to pay attention to and learn are what are our impulse moves. So the impulse moves in the market, these are just these major zones of movement where we might have some overlap from one bar to the next or one day to the next, depending on what time frame you're looking on. But we don't have these zones of longer congestion or correction. So we think of these as like a primary trend move where we have the series of higher highs or higher lows within a channel without puncturing the channel and getting a break of it. Impulse moves, like everything in technical analysis, are fractal in nature. So we'll end up with a bigger impulse move comprised of a lot of these smaller impulse moves. So when I'm looking at impulse moves in the market and I'm trying to determine, hey, am I going to be falling into a larger zone of congestion or correction, or is this going to be a period where I want to build into a position and add into the trend? One of the first things that I want to do is I want to look at what's going on the larger time frames and where are we at in the impulse move levels on those larger time frames. So if I pull up, let's say our NASDAQ chart here, and we look at what's going on like a daily time frame, then what you're going to notice here is that some of our larger impulse moves look about like this. We've got even a smaller fractal one beginning about here, going to about here without really any correction in between. You can see really comparable sized moves a couple of times in a row back here. Over here, though, we're in more of this congestive type of phase. So what we see here are some of the smaller impulse moves that are pretty typical of a lot of the minor corrections that have happened in the past, but you'll notice that they're all very similar in terms of the size here. So a lot of them have these same momentum moves. Hold on just a second, you guys. I had COVID back in January, and I still have this tickly cough every once in a while. But let's see here. Lost my chart. So a lot of them have these impulse moves where there's again, really similar price movement in terms of like how many points something is moving within very similar amounts of time. So when I'm looking at, hey, what am I going to look for a current directional move? When I see something like this, well, we could be looking at two things. We could be looking at, the beginning of a brand new trend, but we also have to watch where when we get into a smaller zone, like some of these minor corrections in here, that that could be a level that we could see reversals happen, or we could see longer zones of congestion go into. So if I have a pattern that's forming on a smaller time frame, this is a daily chart. So let's say like a 240-minute time frame or a 60-minute time frame. What I want to do is I want to look for a larger reversal pattern in those smaller time frames that can kick off some of these bigger momentum moves. But when we get to the smaller comparable impulse move sizes, I want to drop down and really pay attention to what is happening on those smaller time frames. So are we starting to see reversal patterns forming? Is it hitting it with momentum where it's starting to round? Or is it hitting it with momentum where it just touches that zone for that smaller impulse move and then bounces right off of it? The more dangerous places for trying to get a larger impulse move are going to happen if you begin to see this rounding off as you get to the limits of those smaller impulse moves. So this is one of the first things that I'm looking at. If I'm at a zone where when I go up on the larger time frames, there's a lot fewer impulse moves that are the same size, like this here, then that tells me I really need to look for the potential to get some larger bounce action, some larger counter trend moves. And even this on a daily time frame, we could go up to a larger time frame, like a weekly time frame, to look at where we are at as well. And so this is just the first basic thing that I want to look at. And if I have a strategy that's forming on, say, a 60-minute time frame, I need to have the context of where that is happening on the larger time frame, that larger impulse move. So here you can see again a number of smaller impulse moves that are taking place here within some of these bigger trends. And in this situation, I was long on this security and I was looking at, hey, can we go into reversal? Are we going to go into like a correction? Should I be protecting part of my position at this level? And by examining previous zones where I had very similar momentum or rates of change in price action and also very similar size, that told me, hey, I've got to be prepared that we could go into a larger period of congestion or back and forth action, that it could start to get whippy. So it's a good thing that kind of helps identify some of the major zones that we've got to watch for price resistance and price support. So when we dive down into looking at the three signs of trend exhaustion, that very first one is to look at those measured impulse moves. So you'll see here, for example, a couple of really smaller ones here. Now, even though this managed to go and do the start of another beginning impulse move, what you can see happening is that we've got two of these in a row. And I'm going to come back to this trait here as well in just a couple of minutes as another clue for identifying our trend exhaustion. So the measured impulse moves are those first things that we're going to be looking at. You can see multiple moves back and forth, and we have larger ones within the context of even bigger ones. And then we've also got the smaller ones. And so the smaller ones happen much more often. These are going to be levels where you've got to watch out for the potential for longer corrections or zone of congestion to happen. And the bigger ones are going to tell us, hey, we have a much higher probability of going into an even larger zone of correction. So we're going to put these together here in just a minute. But this is just step one. Now, when I'm looking at how to then, place a trade or get out of a trade, one of the tricks that you can do is you can grab your time of each of these impulse moves, draw on your chart from like the low to the high, grab it and apply it to whatever current impulse move is happening. So what you'll start to see is that there begin to be clusters of levels that are happening over and over again in terms of the size and the momentum of those trend moves. And the momentum is really important because you want to be comparing moves that have really similar momentum. If the momentum is substantially different, like for example, this uptrend here, we've got overall a slower momentum move on the upside, then it's not going to translate as well. So when you're comparing your impulse moves, you want to look at those that have very similar momentum. And if I take a short setup on a smaller time frame, let's say in here, right in here, maybe there's a continuation pattern forming, like a bear flag or something like that. Well, this can give me a heads up to how far can that move really go before it has a greater probability of going into a trading range or even turning around. So if I'm looking at a new strategy, I would prefer to get into that trend where it's going to be less than half the size of those larger impulse moves. So a continuation pattern around here where this momentum is very similar to a lot of those larger impulse waves is going to have a much higher probability of giving me a lot more return compared to what my risk is than if I end up trying to take a continuation pattern down in here. So that's your first step. The second one is going to be wave count. How many of you are familiar with Elliott Wave? Or perhaps a better question would be like, who is not familiar with Elliott Wave? So when I first started trading, there wasn't a lot out there as far as technical analysis courses went or lessons or anything like that. We really didn't have access to a lot of the education that you guys have now. And it was kind of a different beast because in in that phase, there wasn't really anyone to turn to try to teach you a lot about it. But in the current environment, you guys are just so overwhelmed with like a million things that it can be hard to narrow down, hey, what strategy or what system should I try? The one thing that you're going to notice throughout my presentation here is that I rely primarily upon pure price action. So I'm not focused as much upon using indicators. Indicators can be great as a confirmation tool, but the problem is that if you don't understand pure price action, like trend development, then trying to understand when to pay attention to your indicators and when to ignore them can be really difficult. So Elliott Wave is just a wave counting system. I don't use it myself, but for those of you that follow it, you're going to see some overlap in how I teach pattern development in terms of the trends development. So Elliott Wave, basically the core basic of it is that they count in 5 major waves. So you'll get a downtrend, a correction, downtrend, correction, downtrend. And so this will be wave 1, 2, 3, 4, 5. You'll also hear things referred to as like ABC, ABCD. And that's the general idea that you've got A, B, C as like corrective moves. So there'll be like a 2-wave correction within the context of these bigger 5 waves. Now, I do focus on this to some degree, but what I'm looking at is also paying attention to time development aspects within a trend. So if we're looking at wave counting, I prefer to count in waves of two. And what you're going to find is that primary Elliott wave trading would be 1, 2, 3, 4, 5. What you're going to see me do in a lot of these charts here is that we're going to be looking at 1 and 2. So this will be 1 and this will be 2. And then each of these can be divided as well. So we'll often see two waves within these. Now, when we do have these three waves of primary trend direction, what often happens is that if you take this correction and add those together, that those often tends to be very typical correction zones. So instead of getting, say, three primary waves of trend movement, you'll have one, and then you'll get a two-wave correction where these two waves added together equal these two. So when I'm looking at this initial movement here, the main waves that I'm counting are going to be this move and then this move. Because what can happen is that this middle one can be many different sizes. So you will end up with a situation, for example, where it can be a really large move, a shorter move, and a larger move again. You can end up with a short move, a large move, and a short move. But what you'll notice in each of these is that the comparison is how long does this time development of these corrections take compared to previous moves. So when we're looking at wave counting, we want these corrections to have the similar amount of time. So if the first correction in our trend has 6 bars, then in order to count another wave correctly, that next correction needs to have about 6 bars as well. Or if you're looking at like 30 days, this will be about 30 days, and then this will be about 30 days. It might be 28, it might be 32, but they're going to be right around that same amount. And when you have two of those in a row, that trend tends to exhaust the trend, and you'll start to go into a larger period of correction. So to clarify, Ram asks, move 1 plus move 3 equals leads to a correction move. Equals, it doesn't equal correction move, but it leads to a correction move. So this would be wave 1, this would be wave 2. This is wave 1, this is wave 2. Wave 1 and wave 2. So you'll notice that I'm not really fully counting this mid-wave move, even though it's there, because of the different ways that this trend can play out. So how do you know when there's wave 1? Well, this move here will be really comparable to many of those smaller impulse moves. So when you go back to like that previous chart, and I'm going to show you guys this on some live charts here this morning too, so that you can see them as they're actually playing out. But if we go back to like this chart back in here, hold on a second. Then what you're going to do is you're going to be looking for comparable moves that are really the same in terms of the size of those movements, and then correction period. So if you've got an impulse move like this, and you've got a longer zone of correction where it breaks this trend channel, then technically this is going to be wave 1. And this would be wave 2. So this again, similar size, wave 1, longer period of correction. So it's breaking that trend channel. That's what's going to lead to wave 2. The more you see this, the clearer it's going to be. One of the things about this particular trend here is that this happens in a lot of securities that you'll see it a lot when things are coming out of major bear markets, where we get the really extreme first wave, and then we get a slowdown in momentum. And then you get an even slower move in momentum. And then what tends to happen is that as these shift, we'll get a break in that bigger trend channel. You'll get a flush. And then after that point, we often see reversals happening. So if we look at, hold on, I'm going to show you guys a chart here, like DKNG. So DKNG here, this has been a popular one with a lot of day traders lately. And what you'll notice is that this is a longer period of correction. This is a longer period of correction. But then we get this impulse move where we have a shorter correction, a secondary impulse move with a shorter correction. And then that third, whoops, my pen going a little crazy there, that third impulse move. So what this tells me is that we're seeing that trend exhaustion here, but this downtrend move could have also been a move that looked like this. So you could have gotten those kind of bigger impulse waves with a longer zone of correction in here that would have been more comparable to like what you see here. So it's kind of looking at previous zones of correction, how long those have taken, and then in your impulse move, if it goes faster than what you see in those previous zones of correction, then you're looking at a greater probability that you will see three waves versus just the two waves coming out of a zone of congestion. So after that point, if you're getting that momentum shifting where it's kind of slowing down on that last leg down, what we often see is a break of that trend channel, but it can easily flush before it goes and tries to turn around. So when you get this trend exhaustion, you've got to be prepared for not necessarily looking for this low to absolutely hold, but being prepared that it could flush it. The greater this momentum shifts as it comes into that low, the less of a chance that flush is going to take out your previous lows. So if you look at Netflix here intraday, what you can see is that this last wave of selling here is substantially weaker than the first wave. And that wasn't really the case on DKNG. It was slower, but it wasn't a lot slower. So if that last leg has a lot of overlap, then there's a better chance that when it tries to do that little flush there, that it won't even take out that previous low, that it will end up holding it. But if you're getting into a buy setup where it turns around and can't really take off, and you're seeing this slower channel here, notice the two waves on the upside, 1 and 2. And this is, again, why it's really important to count in waves of 2 versus just waves of 3, because a lot of our corrective moves will only get 2 waves. So when we go into zones of the market, like what you guys are seeing right now in the larger time frames, we'll often get these wider swings back and forth within the range. And many times those swings only have 2 waves in them. So if they try to go for a third, it tends to be more of a trap. But if you see a move down that has then kind of a smaller correction compared to over here, then you can get 3 waves versus 2. But if it comes up a good halfway, goes into a longer correction than each of these smaller ones, then you're more likely to only see 2 waves, and an attempt to try to go for a third will tend to be stunted. So this is how we look at wave counting. And within each of these, we often will see 2 to 3 waves. And again, the longer that correction in there, the more likely it's going to be 2 waves. But if it's a really short correction, you can end up with 3 waves. So wave counting here is this next thing that we want to look at. If you were to look at a larger time frame on this Netflix, what you would want to see is, hey, as this impulse move is forming on the downside, how does the size of that impulse move compare to previous impulse moves on larger time frames. So if this is 1,000 tick chart, your larger time frame that you would want to look at for impulse moves would be something like probably the 600 to 800 tick charts. And that's where you would see zones where you can get a lot more comparison waves like this move here. So this would be your impulse move on a larger time frame. And when this is coming into support here, you would want to compare this main impulse move with each of these, 3 smaller waves into it to some of the other impulse moves that are happening that have that same momentum on that bigger time frame. And that often can tell you too if there's a better chance that it might flush, because if the larger impulse waves average moves that come down into here, but you're seeing smaller trend exhaustion here, then there's a better chance that it's going to go and do something that will flush into that bigger impulse move zone, that bigger average impulse move zone. So this is a chart of the Russell from earlier this month. And I was trading the upside move coming out of this. And what you'll notice is that we've got a move here where we do have 3 legs of buying in here. But in this case, you've got the smaller one, the bigger one, and then the smaller one. When you add these 2 corrections together, you'll often get zones of correction that will look like this, for example, where it can go into more of a base move versus a tilted move. So when you're counting these trend moves, what we need to see are these zones of correction that are the same amount of time. So since this correction and this correction are about the same amount of time, it left room for it to go and put that additional move up here. So same thing on a bigger scale. This goes into a correction zone here, where we then get the break of that correction, but then we have another really comparable time correction. So on the larger trend, this becomes a bigger leg 1. These are our 2 waves of correction, and then this becomes that third leg up. So again, if you're counting it the way I typically do, this would be 1 and this would be 2. You could count it as 1, 2, 3, but what can happen is that on the way down, this might come down into here and then go into 2 waves of correction like that, where here's our correction compared to here, here's our correction compared to here, and we only get 2 main legs down, and then this goes into a longer zone of congestion, or a even reverses and flips back up at that point. And so you might be wondering, hey, why did I get 3 impulse moves up, but I only got 2 on the way back down? And it's because you're looking at how long this took to correct and this took to correct, adding those 2 together within the 3 wave count, and that gives you that bigger time correction that can happen and make it more likely that you'll only see 2 legs on the way back down. But this wave count here would really be looking like, here's wave 1, wave 1. This is your smaller, your second wave in there, and then here's your third leg. So I'm just not counting the second wave here. And what that does is it helps prepare me for a lot of the bigger trend reversals or trend corrections versus if I'm just counting in waves of 3 or waves of 5, as Elliott Wave would have it. That Elliott Wave would be 1, 2, 3, 4, 5 with 2 waves of correction. And that's how they would count the trend. So this is just showing one of the trades that I did intraday on the NASDAQ. And since this correction here is a substantial price correction, goes into a double top, I'm not counting this as leg 1. What I'm counting is this is the first main leg of downside. Here's my correction. I get a second move in here, a secondary correction, and then I get the third move. So because this secondary correction is the same amount of size as this first one, that tells me I have a high probability of getting that next move down. This could have also looked like this though. It could have gone into a wave here, gone into here, and then broken down like that. So I could have had a zone of correction that looked like this instead and only gotten two main legs of downside instead of the three that you see here. Now that exit zone that I took, and then ultimately I ended up flipping it, was because I'm looking at this main impulse move down here. So my entry is in that upper third of that impulse move where I'm making a comparison to these previous impulse moves here. So since it's in that upper third, when it breaks that channel, it tells me that I have a good probability that I'm going to get pretty measured impulse move action as long as it continues in that direction with the same momentum. It has to have that same momentum as it's following through. If it starts to slow or anything like that, then I'm going to have to reassess. So actually, if we look at like the ES here today, let me pull up that chart. So here's our ES. Clear these and get this opened up here. You can see I was teaching some basics on fib fans here. But if we go down to a, let's see, I want to look at it like a 10,000 tick chart here. So what you can see happening here is that on this current time frame, we had this main leg down, and see how it's broken up. It has the one correction here and the second correction here, and then that third leg. It looks very similar to that trade that I had in the NASDAQ. But this could have just been a flat base here, and then it would have been two waves down versus three. So then we get another move down in here, and again, a two-wave correction. But this could have also looked like that, where that corrective zone would have been tilted. So instead of going into just base action with your two-wave correction, you can also get that tilted two-wave correction in here. And that's what we've got going on right now. So what we have here is your kind of first correction, your second correction, and it's tilted to the upside. So this move here is likely to bring it into an exhaustion zone that this would be your first leg up, this would be your second leg up, and then you would be looking for exhaustion to happen on that one. That's a really good question. Are tick charts better than the normal time frame charts for reading? How I usually do it is when it's during the middle of the trading day, I'm usually relying more on tick charts. And then if it's after hours and I'm trading on, some of the smaller time frames, I'm going to rely more on the time frame charts. But they work just as well on both charts. So you're going to maybe see something where you can see clear trend exhaustion on a tick chart, but it looks totally different on a time frame chart. And when they're kind of lining up, and you may have like the impulse move on a larger time frame chart might show you that, hey, I'm at a zone for that bigger impulse move exhaustion, but you might not be able to count the waves very well. But you go down to a tick chart and you can count the waves. So there can be a little bit of overlap where both of them are really important. Is 10,000 tick a better number for the ES? I like it a lot because we can see a number of some of the bigger impulse moves. So I can see some of like a bit larger patterns that can be forming when I'm looking at a 10,000 tick chart. I'll go down smaller for timing entries though. So like, for example, if we're at an exhaustion zone, like for here, coming into the beginning of the day there, we had pretty close to comparable larger impulse move size in here, even though we've got this, kind of little two-wave correction in here. By the time it reaches this low, we're now at those larger impulse moves. So I would drop down to a smaller time frame to look for specific reversal strategies at that point. And I'll show you actually a couple of the reversal strategies that I use here. Let's move forward so that I can share those with you. So here's another view of how this looks. And this one is on the NQ. And again, this could be just your midway correction zone. So first leg, second leg, and then you've got your trend exhaustion. So like I said, I like to count in waves of twos versus waves of three. And here you can see this over and over again. So even when you have a trend that has a really nice downside move, you can also count these smaller movements two at a time. Even this upside move here, you've got two moves on the way up and two down. Now, what I'm going to show you guys here in a little bit that also goes into trend exhaustion is looking at how our trend channel starts to shift. So we can get these series of three lows or three highs, and the difference between this low to this low is going to be substantially smaller than it is from this low to this low. So you'll start to see a larger shift in momentum. And that's going to be the third thing that we look at as far as trend exhaustion. And I'll show you an example here from today, a NASDAQ trade that I took earlier. And the reasons why I ended up scalping it versus looking for a bigger trend reversal. So here, again, Netflix, that momentum shifting here, that's huge. So when you have a shift in momentum where you've got your first impulse move, second, and then your third, but your third one has a lot of overlap, and down in the smaller time frame, it could look more like, this, but with that trend channel, it starts to shift that channel like that. That's really big for starting to get larger reversal patterns that can happen. So this momentum shifting here is your third clue that a trend is exhausting. So here's another chart. This is a different NASDAQ. We're on even like a 2-second chart here. So it really applies to all different kinds of time frames. But see how we have this extreme impulse move here? Then overall, it's shifting. And so this is a very common bottoming pattern. And the more this last leg shifts, the easier it is that when it tries to do that flush, it will hold those previous lows. Ideally, what you want to see is when it breaks that channel, following that last wave on the downside here, if it can pull up 50% or more of this last move, and preferably more, preferably coming into where this channel broke down here, that is usually going to hold it so that it doesn't just blow through that previous low. So if it can come back up to about here, I call this a target 3 zone on the reversal, then there's a much better probability that even if it goes and corrects again here, that it's going to hold that previous low. So if the momentum has a more difficult time coming off of that exhaustion level, even though the trend is exhausted here, if it goes into a channel that's a lot more gradual, that can ultimately lead to another flush on the downside before it tries to turn around. In our wave counting, the zone that happens the most at is if you got a 3-wave trend move and you have that exhaustion there. Let me do this where our momentum is shifting. So if you got your trend move where it's exhausting like this, typically if it goes into a channel where if we add this one, we'll call this A and this one B together. If we have those added together, that can be where you can get that flush before it will then turn and reverse. And the flush can be really rapid, but what you'll often see is that if it will flip back really quickly too. Now, If this zone here, we'll call this C, is longer than A and B, then we're not going to be looking for a reversal when it flushes because it could just be starting a bigger trend or continuing a bigger trend where this becomes your first larger wave on a new downtrend. So it's very important that this zone here, C, is only A and B, and then you look for reversal pattern. There's a lot of different types of reversal patterns that can happen here. So if this is C, for example, and then you get this shifting like this is typically a huge momentum mover. It's one of my favorite strategies. So if this is your C zone right here, and then it goes into an even more gradual channel on that pullback, preferably two waves, this channel here should last as long as that uptrend move. So if we're looking at this chart here, for example, and this is C here, then we go into a correction like this, and we get that two-wave correction in here. A break of this trend channel right there can lead to really substantial impulse moves. But you need to see that slower shift here and then even slower shift in momentum this way to get that going. So here is another example where we can see that there's three waves, but the first zone is really smaller. It's shorter, shallower. We get a lot of overlap. Goes into that bigger correction where the channel ends up breaking. Second, larger impulse move. And then the third one ends up being shallower again. And that is also a good zone to watch for a reversal of that trend. Now, what you need to see though is from here to here, is this a comparable impulse move on a bigger time frame? If this is your 100 tick chart, again, go up to like your 600 and your 800 tick charts where you see multiple moves of larger impulse action back and forth. So this needs to be right around that comparable exhaustion level. And if it's not, then you could end up with that flush there before it tries to do a bigger correction. So the closer this is into your maximum, so let's say you have some impulse moves, in the past that look, back and forth like that. If this is at the maximum levels where you're looking at all of those kind of put together, then there's a better chance it's going to give you a stronger reversal coming off of that level. This one goes into looking at, how our target levels can be affected. So typically when I'm coming out of a two-wave correction like this, what I'm looking for on the continuation is going to be a measured move, 100% extension. But what I want to see is ideally it'll make it to the 61.8% price extension without a pause. If it pauses at 50% or lower, it can have a harder time getting to that 100%. So here we've got these three impulse move levels. And if we add this one together with this one, then what we need to see is that as that add of those two together happens for a correction, it needs to immediately shoot and continue that trend. If it goes longer than the corrections that are happening here, so here to here added together, if this bases out and corrects longer, then trying to do a continuation is going to have a much harder time unless that longer correction is this amount of time. So if that goes out to here in a zone, that can take off again at that point. So adding in those correction zones together, kind of adding and adding and adding, that's going to create larger zones of correction before a trend has a higher probability of continuing. So this trying to break out here, it's only one leg of this two-wave correction in here. And it's twice the size of these smaller moves. So if it was just A and B, each of these corrections added together, it could take off. This would be your first do or die zone. So the probability of that giving another impulse move would be good here, but not as good here because it's only one wave of correction when you're looking at this bigger impulse move here. So this is your highest risk zone for breakout. Now, if it comes over in here and we get another setup, this is another do or die spot for our trend because it's the same amount of time correction as happened here. So this could go and create that third leg, which would essentially in this case be, if this is leg one, this would be leg two. And this could be a shorter, midway zone in there. So our trend exhaustion now is in counting of waves of two, we've got things starting to shift. You've got a two-wave correction here, but not ideal timing. So then we also have a two-wave trend move up here. So with that smaller impulse move zone, which is really similar to each of these smaller impulse waves here, there's a better chance that this could go into another correction again that will break that trend channel. And it won't have a good shot of continuing at this point. This is going to be a really high risk zone to try to go for a trend continuation there at that point. So the next thing that I'll look at are these momentum shifts that are happening. So if you've got a two-wave correction in here and you start to see a momentum shift where it's hitting like these slightly lower lows or slightly higher highs, that's a really good zone to begin to look for reversal patterns. So if you've got, again, the two-wave movement and then you get this momentum shift, that is a great level for larger trend reversal. Hold on just a second, guys. My Alexa decided to go crazy on me. There we go. All right. So this is actually one of the types of setups that I had happening here today on the NASDAQ. I'm going to show that to you here fast. So on our NASDAQ, we go over to like our 400 tick chart. I actually want to go down smaller. So what you'll start to see here is that we've got these two main legs of correction in here, or two main legs of that trend in here. Again, here's two legs up in here. And this one kind of gets struggles because this time development's not the same as this correction here. This time development is the same. So I'm counting this as leg one, this is leg two. This is just part of the correction. This is leg one, this is leg two. And then look at that shift happening. It's the same shift that was just in our chart here, where we get that shift. So this can be a reversal strategy that is forming. So I took this as a short when it did kind of a double tap here, but I only took it into this zone as a target zone. So this was just a really rapid day trade. And what you'll notice is that here's a two-wave correction here, but the overall momentum is slower. On this pattern where you get the three highs after your two main legs of trend movement, this on a reversal should immediately drop and have a correction that's comparable to some of these initial reversal correction impulse moves. So what I needed to see was this to come into this level really quickly. So if it comes in and it's only hitting half of it, it means that I'm going to go and look for just a smaller measured move. So I'll look for the smaller impulse moves instead of looking for those bigger ones. So if this had come down in here and only had, a little pause correction, then that could have still made it into that kind of bigger impulse move on the downside. So if you're looking at a bigger target level, but it goes into a longer correction than what you see as typical in similar impulse moves, so, like this zone of congestion here or here, if it goes longer than that, then you might need to adjust what your target's going to be and use some of the smaller measured impulse moves instead. Now, another reason that I did this also had to do with the momentum that was happening on the larger time frame. I actually ended up reversing this and continuing it on the upside here just before we were going into our class. And that had to do with the bigger impulse move that was in play on a larger time frame. So even though we have what looks like the trend exhaustion here on this 200 tick chart, if you pull this up to like the 1,000 tick chart here, look at where that pattern was. You've got some smaller measured impulse moves, but we also have some waves of impulse action that are larger than what you're seeing here. So that means that there's the potential that this is only 2/3 of this bigger impulse move. So there's the potential that this could treat this as just one wave of correction, two waves of correction, and then you get your third move like that. So if this had gone into a longer correction like this, it would have been comparable to the one here, to the one here, to the one here. And there would have been a better chance that this would have just had a smoother move up without any pause happening within that entire move. So that could have led to a measured move here and here. But since this did the two shorter waves, I'm treating this like it's a tilted correction here, and it has that potential to do that third leg. So a little bit of a difference here in terms of, how we're counting the waves because of the size of the corrections that are happening. And then also the comparison to some of the bigger impulse moves that are happening. So that meant greater risk that this could go to another move on the upside and that this would not serve as a bigger trend exhaustion point. If, on the other hand, you guys, what we saw happening was that this came up, we had like a two-way move here, it came up, and then we see that 3 high shift here, then there's a bigger chance that this is going to go into a much larger trend correction at that point. Now let's go forward here. You can see this is just another example from another of that same pattern where you got your kind of main leg, second leg shifts that momentum, and then we get our reversal. And look at that reversal. It comes in very quickly. So we don't get much of a pause here. If this had paused and went out like that, then what that would do is that would shift our larger momentum. So we could end up in the same situation as what happened here today, where it shifts like this, and then it's able to take off again. So it's really important to get that initial follow through, and then you've got those larger potentials for continuation at that point. Again, same idea here. And it has that initial confirmation. And we see the exact same pattern happening when we look at COVID cases. So you got your two main upside moves. We get our 3-leg shift here. It comes in pretty quickly to the lower end there. But you've got to watch this channel here. So if this had broken that channel of this two-wave correction, let me kind of make this a different color here. This two-wave move here, if it had broken that channel, it could have continued and given us another stronger move up here. So if it has that kind of middle start zone here, where here's our 3 highs, then it comes up here. Even spacing is usually between each of these highs. It must confirm here, and it should not break that channel right there. Because then what it does is it treats this as the first part of the correction, this is the second part of the correction, and then you get a major move there. All right, you guys. So I covered a lot of somewhat advanced stuff in here in today's session. Next month, in just a couple of weeks here on Saturday, April 2nd, I'm doing a live 3-hour mentoring program where we're going to talk about the 5 building blocks of price development. So one of those is time corrections and the time placement. We've also going to be looking at trend development. We'll be looking at volume. We'll be looking at momentum. All of those things are going to be covered during this live session. This is a class that I've taught for about 25 years. I've taught it for the CME group, as well as to a number of hedge fund managers. I've used it in my commentary with Real Money on thestreet.com. And it's something that is how all of the different patterns in the market, like bull flags, bear flags, how those all are formed. So it breaks up, for example, a bear flag. It breaks this up into specific traits where we look at trend placement, we look at momentum within it, we look at how volume impacts the strategy development, and how those can all be added together to create these really strong patterns in the market. And every single pattern that you trade, even from a reversal pattern off of the lows, is going to be comprised of these 5 building blocks of price development. So I'm going to share with you some specifics of my favorite trading strategies and also how emotions can come into play and some techniques for overcoming the emotional aspects of trading.
Hey,
This
Toni,
program,
we've run
yep,
out of time.
yeah.
We're bang on the hour. Thank you very much for
You're
attending. If
welcome.
anybody wants to take advantage of Toni's offer, you can see the link in the chat box on the right. And thank you for coming. We look forward to working with you again.
You're welcome, everyone. And again, it's 3 hours and it's $100 just for the entire 3 hours. All right, take care, everyone. And I hope you enjoy the rest of today's classes.